Friends, do you know who is the fastest billionaire in the world? Jay Walker, who launched his website Priceline in the early 2000s, due to which his net worth became $1.8 billion in a year. And it took Warren Buffett 55 years to earn his first $1 billion. But when the dot-com bubble burst, Jay Walker $1 billion was reduced to only $333 million. On the other hand, Warren Buffett was included in the world's top 1% richer club earlier also, is still today and will continue to be in future. But what are the personal investing secrets of the richest 1% of billionaires, like Warren Buffett and Ray Dalio, by which they increase their wealth, whereas people like Jay Walker lose their money? That's why we are going to share with you all the investing secrets of the top 1% richest people. Number 1, rich don't speculate. Almost all average people invest on the basis of speculation. Speculation means predicting the future in a way. People somehow prove that what they are thinking will happen, behind which there is no research or strategy, rather, they just hope that they will get very good returns from where they are investing. For example, suppose a rumor is spreading that Apple is going to bring a completely new world-changing technology with its new product, so everyone here will think that Apple will get a lot of profit with this product and more people will start buying Apple stock, which will increase the share prices of Apple, and investors will also be happy. But if people turn out to be unlucky and this rumor turns out to be wrong or it will not make much difference to technology, then people will start withdrawing their money in loss and this will decline Apple's shares. This is the reason why there is so much volatility in the share price of any company, which is due to market speculation. But real investors never indulge in these things as they are not interested in earning short-term returns from the market, they play long-term game. Number 2, rich makes money through dividends. Most of the people think that when to buy stocks and when to sell them, but if you study Warren Buffett's career well, you will see that he never sells his stocks, because he always holds all the stocks. But Warren Buffett does not get any salary and all his wealth is in stocks only. To earn money they have to sell these stocks, but they do not do this, so how do they earn money for daily living? Well, whenever a company makes a profit, the company has two options, either keep that money in the company's funds, or distribute it among its shareholders. And many big companies, instead of keeping profits with themselves, directly distribute those money to their shareholders in the form of dividends, which directly comes into their bank accounts, and the more shares of that company you hold, and the longer you hold it, the more dividends you get. That's why Warren Buffett earns more than Coca-Cola's CEO's salary from Coca-Cola's dividend, and this happens because of the growth of the company, its stocks, investing, and high consumer needs. Number 3, never lose your money. Warren Buffett's most important rule in investing is, rule number 1, never lose money. Rule number 2, never forget rule number 1. That's why the number 1 priority of the world's richest investors is to protect themselves from any kind of loss, for which they keep their portfolio diverse. Whose greatest example is another great investor of the world, Ray Dalio, who had diversified his portfolio so well that in 2008, where almost everyone was facing loss up to 50%, even the great Warren Buffett also had a loss of $23 billion. At that time, Ray Dalio had lost only 1.8%. Tony Robbins interviewed the top 50 best investors in the world in his book, Money Master the Game, in which he saw only one thing in common, where all those people were passionate about the same thing, where they didn't want to earn high returns, rather they just wanted to avoid losing their money in any way, where they wanted to see maximum returns and take minimum risk. That's why Benjamin Graham also used to say that before looking at the history of any stock, you should keep in mind the history of the market, because you have to learn to be mentally prepared even for the uninvited recession. At the time of recession, all other people lose their money and sell stocks, while all top investors are mentally strong, who deal well with the market because they know that the market always recovers. That is why all the richest investors understand that they should never put all their eggs in one basket and should always diversify their investments as much as possible. Number 4, pricing versus value. Rich people focus the most on the pricing and value of that company before investing their money, so that they check that the amount of money they are going to invest, how much value they are going to get in that money. Whenever the prices of a company are decreasing from its intrinsic value, then all the intelligent investors understand this opportunity very well. That is why they invest in such companies whose price is low and their value is very high. For example, Warren Buffett bought American Express stocks when the company was unable to pay its debts, due to which the value of American Express shares was reduced by more than half, but the company was doing well, there was no problem, it just had a huge financial loss. Warren Buffett saw that its share value was very underpriced, so he bought $13 million worth of stock, an investment that is now worth more than $23 billion. So guys, this video ends here. If you want to keep watching such interesting videos for free every week, subscribe to this channel and press the bell icon, share this video with your friend and family. Thanks for watching.